Sticking with the utility stocks here. Traditionally, this group is supposed to be punished when the Federal Reserve starts raising interest rates in earnest, which they're doing, because their dividends become less attractive in comparison. But so far this year, the utilities have actually been holding up pretty well. Take Entergy, ETR, up 7.5% for 2017. Here's a company that's trying to transition away from wholesale power generation, focus on being a pure play generator. It's just going to do, this is going to be a regular utility, and I like those, and it's in the Deep South, which is a great growth area. Now, Entergy reported a solid quarter in late April, maintaining its full-year guidance, and it pays you a bountiful 4.4% yield. But the hedge fund playbook says you sell the utilities when the Fed's tightening. Yet this thing just keeps climbing. So should we be concerned here, or is this a unique case where the playbook could be wrong? Let's take a close look with Leo Denault. He's the chairman and CEO of Entergy. Hear more about his company and its prospects. Mr. Denault, welcome back to Mad Money. Good to see you, Leo.
Great
Thank
to see you.
Have a seat. So I'm thinking that your utility, one, is bucking the trend because it's going into a much more simplified manner, but also you've got growth. Both
Correct.
of these going for you.
Correct. We're in a process right now of really modernizing our infrastructure as a company. New power plants, new transmission lines, moving into more technology on the distribution grid. We're doing all of that while we move away from the wholesale business, as you mentioned. But also, as we do that, we have a growth story in the industrial sector along the Gulf South, which you yourself have talked about many times.
Endlessly. Now, I just want people to understand, what is the risk of the wholesale business, and why do you think it's better to have the steady growth?
Well, one, the businesses are completely different. When you're in the wholesale business, it's like a commodity trade, and we're trading power, which on the margin is natural gas in all the markets where we were located. One, natural gas prices have dropped tremendously, and our asset base in those markets was primarily nuclear.
Right.
And so when the gas prices dropped, the power prices went away, so did the margins, and the business just isn't profitable. But more than that, we've been trying to transition from it even when it was profitable because it's so volatile. And when you look at utility stocks, you're looking at steady, predictable growth in earnings and dividends. That's what we want to provide. We've got a great growth opportunity in that utility. So it's really a capital allocation question as much as anything else. Where are you going to put your money? Are you going to put it in those assets that are a commodity play that are losing money? Or are you going to put it into the tremendous growth that we have in the utility?
Okay, so commercial, industrial, residential, all three doing well?
Well, the residential sector, we've seen flat to declining growth.
Why
we have
is
around the
that? Because
it's a combination of things, but mostly energy efficiency. We've had a tremendous change in light bulbs, for example. You would think that wouldn't make a big difference, but you change out every light bulb in your home and do that for a couple of million customers. Next thing you know, you've got load growth going down. We also have much more efficient appliances. In New Orleans area, we've had a change out in the housing stock over the last decade where we've seen much more efficient, more energy efficient homes. That is what's playing across the country as it relates to the residential sector, similar in the commercial sector. For us, major manufacturing growth in the petrochemical industries, chlor-alkali, refining expansions. Those sorts of chemical businesses have really been a boom for us.
Okay, look, one of the things that I want to make clear to people, your institution has been far ahead of almost every other fleet in terms of sustainability, reduced emissions. It's something that you did voluntarily all along. Therefore, I have to ask you, Paris Accords, leaving them would be seemingly antithetical to the record of Entergy.
Well, it's not really clear what the Paris Accord itself was going to do to impact the company itself.
But the ethos of your company is to have a smaller footprint. It's what you guys have done. The idea, some would say, of thumbing the Paris Accords is against the idea of the footprint.
Well, in reality, what we're going to do with our asset mix is unlikely to be different now than it would have been with the Paris Accord.
You're not saying, listen, we're going to go embrace coal.
No. And actually, we burn very little coal as it is. We have 50-year-old coal plants. It's only about 7% of our generation.
And they're going to go out
today. And over time, they are, because you just don't spend the money on 50-year-old plants to keep them going that you would with the new technologies being much more efficient, much more environmentally friendly. They use less water. They 40% fewer CO2 emissions in a gas plant we build today, and we're building a lot of them versus the ones we'll retire, and the gas footprint as well. So for us, the coal mix is going to decline over time as we increase in gas, continue to spend money on the nuclear fleet, because we do get a significant amount of our energy out of nuclear power as well. And then over time, we're seeing that renewables, storage, those sorts of things, the price points of those is coming way down. And so over time, our mix is going to be the nuclear plants that we already own, nothing new.
They're too hard to build now.
Too big for the footprint of what you need to do as a company like us. We're going to continue to upgrade our gas fleet, and then as renewables become more and more cost competitive, we'll continue to transition into those. Plus a lot of technologies on the distribution grid that are going to help our customers use less electricity.
Yeah, I love that Con Ed's doing that too. Last week, Tropical Storm Cindy, you checking in, everything okay?
Everything's okay. It had less impact on us than we anticipated. We were ready for much more. Thankful that we didn't get that. Still had about 35,000 customers out at peak, but we were able to get most of those on very quickly. So we're ready. It was a good trial run, but hopefully nothing.
Well, I think the transition to being pure play is something I like very much, and that's why one of the reasons I think the stock has done so well. It's just easier to understand.
Exactly.
All right, terrific. That's Leo Denault. He's the chairman and CEO of Entergy ETR. You know I've been backing this one. I am sticking with it. I love the industrial side, but I love the clarity. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.